See how joint bank account terms on fees, APY, and debt responsibility affect couples at every stage. Sharing money plays a role in almost every major relationship decision, from splitting rent to building a down payment fund. A joint bank account or shared credit card can make those goals easier to reach. It can also lock two people into shared responsibility for balances, withdrawals, and debts, even when only one person made the choice that created them. Before adding a partner's name to an account, it helps to understand what joint ownership actually means and to talk through expectations first.
An unlocked iPhone 14 for just $299? This renewed 128 gig model gives you a vivid OLED display, 5G, and the freedom to choose your carrier. Want to check today's Amazon deal? Scan the QR code now or visit grabdeal.us/6 before it's gone.
Federal consumer protections cover much of what banks and card issuers must disclose, but the harder questions, the ones about trust and shared goals, happen at the kitchen table. With a joint savings or checking account, each owner generally has equal access. Depending on the account agreement, either person may be able to deposit money or withdraw it, sometimes without the other's approval. The Consumer Financial Protection Bureau explains that one joint owner can, in many cases, empty the account and close it without the other's consent. That level of access is part of the appeal for couples pooling household bills or saving toward a shared goal. It is also why a joint account is a serious step. Reviewing the account agreement and key banking terms before signing can spare both people surprises later. A joint credit card works differently. Both account holders are generally responsible for repaying the balance, even if only one person made the purchases, according to the CFPB. That means one partner's spending habits can affect the other's credit and cash flow. If the balance goes unpaid, both names sit on the debt. Money conversations are among the harder ones in relationships, but skipping them is riskier than having them. Questions worth working through before you sign anything include the following. The CFPB recommends couples work through shared financial decisions in advance to head off misunderstandings. Not every shared product offers the same terms, and small differences add up over years. For a joint savings account, compare the annual percentage yield, monthly maintenance fees, and any minimum balance requirements. For a joint credit card, look at the annual percentage rate, annual fees, and late payment fees. Federal rules require banks and card issuers to disclose many of these terms up front. The CFPB's Guides to Regulation DD, known as the Truth in Savings Act, and credit card key terms walk through what to expect on those disclosures. Circumstances change, sometimes quickly. Before opening a joint account, ask the bank or card issuer two practical questions. Can one owner be removed from the account later? The answers vary by institution and by state law. The CFPB has guidance on removing a joint owner from a checking account and on what happens to a joint bank account when one owner dies. Getting those answers before opening the account, rather than in the middle of a divorce, a job loss, or a death in the family, is one of the simplest forms of planning a couple can do.